Savings with permanent home markets, an extension to inflation, wealth disparity and unaffordable housing. One of the problems addressed in permanent home markets is the increase in wealth in Australia going to the top 10%. Permanent home markets remove the advantage of the wealthy and give the bottom 90% the same access to housing wealth. Some of the advantages of permanent home markets are, first and primarily, there are no loans. We don't need loans in order to transfer a house from one person to another. It's completely unnecessary. When we remove loans, we in effect remove the interest cost associated with those loans. We still give investors a return on their investments, but they're not done through loans. They're done through investment in the properties. And this means that we can have inflation-adjusted returns. At the moment, rich people have an advantage over anyone who is poorer than them. The wealthy people get a better deal on loans than poorer people. And in fact, most people have very limited access to capital. Let's see what the result of doing this is. We'll take a property, and it's $1 million property, weekly rent of $1,000, interest rate on loans, which we could possibly get 6%, years for the loan 20, repayments per year $87,145, and the average interest that we pay per year is $37,185. Now the interest varies, but initially it's much higher in the first few years. In fact, it starts at $60,000 and then it works its way down. So the interest you pay each year is on average $37,185. That's all unnecessary. So by getting rid of that interest, we find several things happen. One is obviously that there is more money of the $87,145 to benefit the investors and more money to reduce the cost of the repayments. You don't necessarily reduce the amount of money that you're repaying, you just repay more quickly. Let's start with a negatively geared person and what happens to them in year one. The repayments that they're paying out is $87,145. In the first year, interest on this is $60,000 and they're getting in rent per year. They've also got expenses of insurance, letting, repairs, taxes, depreciation, about $49,000. They're making a loss of $59,000. They're negatively geared, so they're getting back $22,125 in tax. They have an increase in capital, so we can add those up and we find that they're getting a net loss in the first year of $16,000. If instead of being a negatively geared property, they put their money directly into a permanent housing market, that money stays there and it increases every year by 5% CPI adjusted. Negatively gearing simply transfers money from the tax department to the bank. At $60,000 up the top there is a lot of money. And in $16,000 of it, or $17,000, comes from the tax department and the rest comes from you. It looks a pretty clear case that negatively geared people will want to join permanent home markets. So let's look at a person who's managed to buy the house entirely, and we'll use the same figures from before. Now what they're doing is they're making a profit of $1,000 and they're hoping for capital gains. BHM, they get a wealth increase of $50,000 a year. All those other costs are no longer theirs, and so they just simply get $50,000 a year, again CPI adjusted. A retiree with a 100% ownership can start to access their capital they can sell a large chunk of the capital and then put the money back into the permanent home market and continue to pay back the $300,000, but get an income from the $300,000. The particular details will depend upon the permanent home market. But let's assume that they get extra income of $20,000 and they get access to capital of $300,000. That's what they will get by joining a permanent home market. It's better than the other way of accessing the money in their home is to get a reverse mortgage. A reverse mortgage simply gives money to the bank. A renter is very much like a retiree. They've got nothing to lose and everything to gain. And in fact, in this particular case, they will gain $20,000 a year because that will become capital that they will be able to use for their next house. Or let's have a look at a mortgage holder. Mortgage holder payments are $84,000. If they're 10 years into the 20-year mortgage and they join a permanent housing market, their repayments can drop to $64,000. Again, because we don't have to pay the interest. If they start at the start of the payment, then their repayments will be $50,000 rather than $84,000. So it's a reduction in cost, $20,000 if they're halfway through, or $34,000 if they do it right at the beginning. And again, as they acquire capital, there will be potential access to that capital. There are other benefits. Because it's a permanent housing market, the costs of buying and selling drop dramatically, because when you change a new occupier comes along, there is very little to be done. And that can be done by the permanent housing market. And we expect that the cost will be down around about the 2%. The PHM also replaces any body corporates. And for those people who are not part of a body corporate, they now have a body corporate group that can act on their behalf. And that means that the body corporate group, which the occupiers own, it's expected that the insurance will drop as the PHM can handle small claims as they occur. You won't need insurance for the small things. You'll only need insurance which the PHM will arrange for the whole house effectively. You can, of course, have extra insurance if you wish. That's up to you. But I think many people will remove a lot of their insurance. It's also expected that many social services will take advantage of the PHM to deliver services, things like aged care, NDIS, costs associated with housing. We've seen that occupiers and investors benefit. Private bank shareholders may not benefit immediately, but we expect that a lot of those will move their funds, they'll sell their private bank shares and move into these permanent housing market investments. Real estate businesses will suffer, but they are good salespeople and they will move to other areas, not necessarily in real estate, but good salespeople are always valuable and can be selling other things. Similarly with conveyancing lawyers, they will lose a lot of their business, but they will have a lot of more investors who are looking for their business will change, but they will still have plenty of work to do. And tax accountants are similar. A lot of their work will go, but there will be a lot of work for looking after people's investments. We don't think there'll be a dramatic change in those business people. Challenges. The major challenge is deciding how to share profits between investors and occupiers. Getting rid of interest releases a lot of money. That money has to be distributed between investors and occupiers. And each individual permanent housing market can decide how it does it. But it's a good problem to have. Choosing between multiple applicants to occupy a house will now become a community decision, not the decision of a landlord, an individual landlord, or the decision based upon how much money a person has. The body corporate functions are also interesting because the companies that look after these permanent housing markets will be owned by the permanent housing markets. They will use the same sort of system as is used by the permanent housing market. That will be interesting to see how that evolves. Thank you very much for listening. My name is Kevin Cox. You can contact me there. And White Label Personal Clouds is available to work on a detailed specification or implementation of a trial PHM.